Every day, trillions of dollars worth of risk changes hands in silence. Weather risk, earnings risk, election night risk. The risk that a chip launch flops or a hurricane misses a refinery by 5 miles. The risk that a central bank blinks, that a rival bids, that a rumor becomes reality at 9:31 a.m. And here's the strange thing. The cost of these possibilities, the price of what might happen, now has a ticker. It is quoted to the 4th decimal place and negotiated in milliseconds by people who will never meet. Risk has a market. Risk has a price tag. How did that happen? This is the place where money, power, and history collide, and nothing is ever as simple as it looks. Options math didn't just tame uncertainty, it itemized it. It put the future on a menu. You can walk up to the counter and order upside without downside, protection without ownership, time without commitment. Pay at the window, settle every night, hedge if you can. The world calls this sophistication. The traders call it survival. And if you follow the chain of equations long enough, you discover something unsettling. The math is immaculate, the plumbing is intricate, and the whole edifice rests on an assumption disguised as a promise, that you can always find someone on the other side when you need them. The story starts with a quiet manuscript in Paris in 1900. Louis Bachelier, a math student, writes a thesis titled The Theory of Speculation. He has the audacity to model stock prices as a random walk, not destiny, not divine favor, a drunkard's path, with each step independent of the last. He sketches how a fair price for an option, the right but not the obligation to buy or sell in the future, could be computed if you accept that future prices wander unpredictably but with a measurable wobble. It is a radical confession for markets, built on stories and whispers. We don't know tomorrow, only the distribution of tomorrows. The establishment yawns, traders keep trusting their gut. The thesis gathers dust. Half a century and 2 wars later, computing power blooms and the exchanges become louder, faster, messier. In 1973, 2 papers land like thunder. Fisher Black and Scholes write down a formula for the price of a European call option, and Robert Merton gives the calculus that makes the formula breathe. The idea is so strange, it's simple. If you can hedge continuously, meaning Jovega, long theta, you collect a coupon for agreeing to be calm while others get scared. Combine them carefully, and you can shape your exposure, not just yes or no to the underlying, but to the very shape of how the future might arrive. The market becomes a laboratory where you can buy curvature and sell time, lease direction and insure against jagged paths. And like any lab, the experiments are clean until everyone tries the same one at once. Because hedging changes the thing you're hedging. Delta hedging textbooks live in a world of frictionless adjustments and perpetual liquidity. Trading floors do not. When thousands of desks buy stock because they're short calls and the underlying rallies, their buying pushes the rally further. When they all sell because puts are in demand and the market dips, their selling deepens the dip. Feedback loops appear. Math meets reflexivity. Prices cause hedges. Hedges cause prices. Democracy decides who governs. Markets decide who survives. Even inside the model, a hairline crack spreads. In Black-Scholes, implied volatility should be the same for every strike and every expiration. 1 sigma to rule them all. But plot implied vol across strikes, and you get a smile or a sneer. Deep out of the money puts trade with higher implied vol than at the money options. Translation. The marmis pricing's into mortal danger. Leverage multiplies assumptions. In 2008, tail risk that had been sliced, diced, and labeled as safe recombined in a storm. Volatility went from a nuisance to a lifeboat. Options weren't side bets anymore. They were the oxygen mask that dropped from the ceiling. In 2020 and 2021, waves of call buying collided with dealer hedging, and the feedback between gamma and stock forced squeezes that melted screens. The lesson is ugly and useful. Options don't just measure risk. In the wrong conditions, they manufacture it. Behind the screens, the system is plumbing. A customer buys a put. A dealer sells it and immediately starts to neutralize by selling a taste of stock, just enough to offset the option's delta. As the stock falls, that delta grows more negative. The dealer sells more. If a crowd buys puts at once, dealers sell a lot at once. Prices slide through air pockets. The same machinery works the other way when calls are in fashion. Dealers find themselves short calls, buying stock as I. So what does the math actually say, stripped of mystique? It says that if you can replicate a payoff exactly with ingredients you can buy and sell, stock and cash, then the option RS fair price is the cost of those ingredients. No arbitrage. It says that if you hedge aggressively enough, you can make drift irrelevant. Whether the stock is supposed to go up doesn't matter because you've neutralized direction. What matters is how rough the path is. Volatility is the toll booth. But the math also confesses its fairy tale. Continuous hedging is impossible. You cannot trade at every heartbeat for free. You trade in lumps, you pay a spread, you slip a little each time. Those frictions create a gap between the platonic price and the mortal price. Traders live in that gap. Sometimes they farm it. Sometimes it swallows them. And then there's the duel between implied and realized. The market quotes what it charges today to wear uncertainty for a while. Later, the world reveals how much it actually wobbled. The spread bet vega, long gamma, negative theta. You own curvature and pay rent to the calendar. If you sell options, you are underwriting short vega, short gamma, positive theta. You collect rent and promise to show up when the building catches fire. Don't pretend you're doing one when you're doing the other. Second, assume slippage. Every hedge is a friction story. Build the cost into your expectation, or it will find a way to introduce itself at the worst time. Third, respect liquidity. Strategies that depend on leaving through a narrow door along with everyone else are not strategies. They are crowded fantasies. Fourth, mind regimes. Implied volatility that looks rich during policy calm can be cheap ahead of elections, energy shocks, or funding squeezes. Fifth, diversify your Greeks. Short gamma in 3 different tickers is still short gamma. A dozen underlyings do not change that implacable arithmetic. Sixth, price the path, not just the point. You can be right about where the stock ends and wrong about how it travels. The market pays for the journey. There's a human layer beneath all the knobs and dashboards. Fear and greed are the same animals they were in Bachelor's Day. Only the cage has changed. The formula that let us put a price tag on risk also gave us a way to misunderstand it with impressive consistency. People will sell downside too cheaply after a decade of quiet because their spreadsheets learned the wrong lesson. They will buy upside too expensively during a frenzy because nothing on the screen looks as good as a straight line up. They will believe that because a replicating strategy worked flawlessly last month, it will work tomorrow at larger size, across more desks, through thinner doors. They will forget that hedging is a promise to trade at future prices you cannot see with counterparties you cannot control. They will confuse the elegance of the equation with the generosity of the world. And yet, the achievement stands. Options math gave us the language to negotiate with uncertainty rather than merely scream at it. It gave us a dictionary, delta, gamma, theta, vega, RO, for translating opinions into exposures. It gave us the idea that you can separate what you believe about direction from what you believe about turbulence, that you can pay rent for time rather than panic about it, that you can insure a portfolio without liquidating your convictions. It didn't eliminate risk. It measured it, chopped it, traded it, and sometimes, when the plumbing groaned, magnified it. Walk back through the decades with that lens. You can see the same cycle again and again. A new tool arrives. It spreads. It works so well that it becomes invisible. And people stop saying, I'm selling crash risk, and start saying, I'm harvesting theta. They rename danger as yield. Then a regime shift exposes the true exposure. The people who knew what they were actually long and short survive. The ones who learned a euphemism perish. The market is cruel about ontology. Name your risk correctly, or it will name you. There's another quiet truth sitting beside the screen. The price tag on risk is a truce between math and behavior. The math insists on replication and no arbitrage. Behavior insists on panic, herding, forced selling, and the occasional saintly patience. The math says volatility is just the standard deviation of returns. Behavior says volatility is what you feel when your phone won't stop buzzing. The math treats liquidity as a shapeless lake. Behavior turns it into a mirage. Both are true enough. The trick is to know which world you're in before you write the check. The future is not bedrock, it is trust. And trust can vanish overnight. That's why option markets exist, not because we learn to predict tomorrow, but because we learn to price our ignorance of it. The premium on a put is not a prophecy of doom, it is a receipt for worry. The premium on a call is not a warrant for victory, it is a fee for hope. Together, those receipts add up to a civilization that can finance bridges, insure crops, launch companies, and survive bad weather with fewer revolutions. That is the generous story. The darker story lives in the feedback loops. When the insurance is underpriced for too long, firms build cities on floodplains. When dealers must hedge in the same direction at the same time, they pull the tide together and drown each other. When policymakers soothe every tremor, they train the public to stand on the fault line and sell earthquake insurance for lunch money. And when frictions return, funding strains, balance sheet edges, basic fear, the smooth surface shatters and the old animal spirits race through the cracks. So the answer to the opening riddle is not mystical. Risk has a price tag because we learned how to replicate payoffs well enough that markets could enforce fairness most of the time. And because we built institutions willing to stand between buyers and sellers long enough to keep the promise. It is a marvel of intellect and a feat of logistics. It is also a bet on ourselves, that we will remember the assumptions beneath the formula, that we will respect the plumbing that makes the quotes meaningful, that we will not confuse the rent we collect with the absence of landlords. If you want a single sentence to carry out of this, take this one. Volatility is the rent you pay for not knowing, and options are the lease. Everything else, delta, gamma, theta, is how you negotiate your lease terms. If you underpay long enough, your landlord will evict you with a crash. If you overpay forever, you will go broke slowly. Somewhere between those extremes lives the craft. Politicians talk about stability, models talk about fair value, markets talk in a different dialect. They ask, at every tick, what you're willing to pay for the next surprise. And they do not care what you paid yesterday. They will take your conviction and sell it back to you as a probability. They will rent you time at a rate that reflects both the weather report and the last storm that kept you awake. They will punish you for forgetting that time has a direction. They will reward you for remembering that path matters more than point. When you hear someone say, vol is cheap, ask, compared to which regime? When you hear theta is income, ask, against what guarantee? When you hear, we're hedged, ask, through what door? The moment you stop asking, risk stops being a price and becomes a personality test. The path from a dusty French thesis to a trillion-dollar machine is not an arc of inevitability. It is a ledger of ideas tested against reality, and a reminder that every elegant solve hides a seam. We turned uncertainty into something you can lease by the week. We built dashboards to translate fear into numbers and then built careers on moving those numbers around. It's an accomplishment worth admiring. It's also a mirror worth staring into. Because when the next storm arrives, and it always does, the market will present you with the same choice it has presented to everyone since options first traded in the pits. You can be one of the many holding pretty receipts for possibilities you never examined, or one of the few who knows exactly which possibility you rented, for how long, at what price, and through which door you plan to leave. Risk has a price tag. Don't forget who's writing it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.